This is what it looks like. It is basically if the borrowers put down 15%, we will pick up the cost. This is on conventional deals. So in Monterey County, that's up to a loan amount of 920. In other counties that don't have a high balance limit, then it'll go up to 766, 500. So if they put 15% down, there's no mortgage insurance. Where this really works well is if you have a client who, or where we're seeing success with it, if you have a client that went in at 20% and maybe you get a low appraisal, they don't necessarily have to take on the higher mortgage insurance payments. And so that's where we've seen the most success with it, is that it's kind of something that we throw in after. Hey, don't worry, like even if the appraisal comes in low, we have this Bye PMI option. To be clear, we're not seeing a lot of appraisals coming in under value, but giving them this as a second option. So even if the appraisal did come in 5% lower, we're not going to change your payments. You're going to have the same monthly payments and you can still move ahead with your offer without any fear of like, oh my gosh, the payments are going to change and everything's going to get difficult. As long as the appraisal doesn't come in significantly lower, then we're okay. And in most cases, what we're finding is that we don't see appraisals coming in significantly lower. That is the 15%. We call it Bye PMI because our marketing department is lovely, and that's why we call it that. I'm sure we could have done better. But anyway, that is what we call it. Any questions on that or PMI in general and how that stuff works?
I do have a question. What is
Yes.
the minimum down payment for a conventional loan?
Most of the time it's 5% down. So when you're looking at the higher end stuff, it's 5% down. You can actually do 3% down in some situations. The pricing is significantly higher at 3% down versus 5% down. And so just to, I guess, anecdotally, something to be aware of, like it sounds obvious, but it's not obvious. People are like, well, I just want to put down the minimum. And a lot of times when you show them what the payments are with the minimum down payment versus 10% down, 15% down, 20% down, like the payments are significantly higher because you're borrowing more money. I know that sounds super obvious, but you'd be surprised how many clients we sit down with that are just amazed. Well, I didn't know it was going to be that much if I only put down 5%. Right. Like, payments are higher when you borrow more money. That's still true, right? So we always show them multiple options, but to the answer to your question is 3% is the absolute minimum. 5% is usually the standard in what we sell most of the time. It's the reason for that is loan amount's a little bit smaller, payments are a little bit lower, and it looks better. Daniel, what do you got?
So PMI drops at 78 loan to value. Is that correct?
78 or 80, yeah, if you push it.
So
So the
you could
way
just
the way
pay a
so
chunk of that if you had the money down the road.
yes,
Like here's 10,000. This will cover the rest of my down payment. Okay.
100%. And
All right.
we've done
Perfect.
that with clients before. Like if they've got where we see it a lot is where we're seeing it a lot right now is I'm selling and then I want to buy before I sell and I qualify with 5% down. I qualify with 10% down. I really don't want to have mortgage insurance. So as soon as my house sells, I'm going to have this big chunk of money. Can I come in and throw that at the payment? And you absolutely can. Just some qualifiers. That's true of conventional loans. That's true of Freddie Mac, Fannie Mae. If you do an FHA loan, which we see in I love that I'm talking to like 17 markets here. So like in in like other in usually in lower cost areas, we do a lot more FHA deals. When you see FHA, that mortgage insurance doesn't go away at all. Or if you put down 10%, it goes away in like 10 years. So really telling people you want to just when people ask about how can I get rid of my mortgage insurance, the right question is what type of loan do you have? And they don't know. Like just to be clear, they're not like you're going to ask the client, what kind of loan do you have? Well, I don't know. The guy just gave me a loan. Like that's the answer I get, right? And I'm like, okay, is that conventional or FHA? I remember there were letters, you know what I mean? Like the clients don't necessarily have that answer, but get them in front of a loan person and we can see once we pulled credit, it'll say FHA loan, it'll say conventional loan on their credit report. So we'll be able to tell them what they have, or we'll get their original paperwork from them. So the other caveat to know is there's a 2-year wait before you can take it off if you're trying to get it for an appraisal, meaning the market's going crazy. I bought this house for 500,000. I put 15% down. I know for sure it's worth 550 now or 560. And so I should be able to just get an appraisal and get it done because now the market says it. Not true. Like there is a 2-year minimum on value unless like the back door to that is if you can prove that you did substantial upgrades. And that's like and we take receipts as proof, right? So I put in new carpets, I knocked down walls, I repainted, I did all these actual improvements and now it's worth more, then they'll let you take it off. If not, there is a 2-year wait until you can prove that equity. There is no wait though for the way you said it, Daniel. If they've got extra cash and they throw it down and they just pay it down, then it goes away.
I have two questions actually.
Yeah.
So you mentioned like I guess the lowest you can do for a conventional is 3%, and I know you can do 5%, but I guess what qualifies someone to do a 3%, 5%, or even a 20%? Like what makes them qualify for each one?
Ultimately, it's all going to be debt to income and credit, right? So like, can they actually qualify for the loan? Can they substantiate that their income is enough to make these payments and that their debts are low enough that it's not going to be too much? There are 3% down. There's a few programs for first-time buyers. If you put 3% down, and they actually get lower mortgage insurance, and they also get a little bit better pricing. And for those, you have to prove that you're a first-time home buyer, and that's easy. You just have to show that you don't own any other homes. It's not the dream for all. We're not going back and looking at their prior life history and all that stuff. Like, it's literally, if you're a first-time home buyer, meaning you haven't owned a home in the last 3 years, then we can do, there's two. There's one that Fannie Mae offers and one that Freddie Mac offers. That's like Home Ready and Home Possible. They're basically designed for first-time buyers. So if you can show first-time buyer, you can almost always do the 3%. When you stack them up next to each other, like the 3% for first-time home buyers versus just a regular 3% where you're not a first-time buyer, the rates are about 0.25% to 0.5% higher.
Oh, wow.
So from a qualifying standpoint, it's, do you qualify to make the payments? Can you make the higher payment with the 3% down and then credit and income? And if you are a first-time home buyer, it's a discount. So the right answer, Miguel, is you can do it either way as long as you qualify, but you'll get a better rate and you'll have a lower monthly payment if you are a first-time home buyer doing 3% down with Fannie or Freddie.
Gotcha. Okay. And then my second question, I'm generally just curious, like how much is PMI anyway? I know it varies. I'm sure it varies on like the price point of the home, but like how much does that even cost in general?
Yeah, so that's actually a good question because it's not that bad, like, to be honest. So for comparison, FHA has a straight MI cost of 50 basis points. That's 50.50% of the loan amount, and then you divide that by 12. Conventional is based on two factors. It's based on credit and also down payment. So part of the reason we're willing to do the 15% down Bye PMI is because that's like where it gets the cheapest. So
Oh, gotcha.
let me take you behind the curtain. We're willing to pay it when it's not that expensive. You know what I mean? So, for instance, 3% down is gonna have higher mortgage insurance than 5% down, which is gonna have higher mortgage insurance than 10% down, 15% down. We used to do a thing where we would have somebody put down like 19%. They would wait because the rates are a little bit better when you get into that range, like that, like 20 to 15% down. Since the rates are a little bit better, we would have them do that and then just pay down the mortgage as soon as they got it done. So kind of doing a hack on Daniels to get them a better rate and then
Right.
insurance removed. The short answer is it's based on credit. I've seen it as low as like 0.05%. So like we got a $920,000 loan. The guy's got perfect credit. He's signing Saturday, closing Monday. Sorry, I'm kind of in shell shock on this one. It was really kind of came together, but his mortgage insurance is like $100 a month on a $920,000 loan. Compare that to somebody with really not awesome credit on a $500,000 loan. They've got credit scores in the 6s, not the 8s like this guy. That's a $500 a month hit because they're not putting as much down. This guy's putting about 10. Oh gosh, what is he putting down? It's $1,080,000 purchase price with a 920 loan, so he's putting down like over 5%, but not a lot over 5%. So the lower down payment with the bad credit can have like a $300, $400, $500 payment. So it's not a bad idea when people say, like, it's a good objection to raise. I'm a believer in objecting a little bit to the clients and not just doing what they tell you. I think there's an old book called The Challenger Sale, which it basically explains how, like, if you give a little bit of resistance, you can give better advice, not just saying whatever the client wants to hear. So when they say, I want to avoid mortgage insurance, you go, have you priced it lately? Have you looked at it lately? You can definitely throw this on me. You can say, you can talk to my guy and he can price it out, because in many situations, the mortgage insurance isn't that bad. Like, I told somebody the other day, they had a $100 mortgage insurance payment. They're like, dude, what was I worried about? And I'm like, I don't know what you were worried about. Like, I really don't. A lot of that comes from like the other people in their ears, right? Like if they hear my dad said to avoid mortgage insurance. Well, when your dad bought a house, mortgage insurance was like 1%. Like your dad's mortgage insurance was like $500. What's happened since is there's like 7 national mortgage insurance companies and they're all fighting for business. So they're getting competitive on their rates. So there's a lot of different ways we can structure mortgage insurance to make it look a little bit better for the client and be a better payment. And there's also programs like the no PMI where we can actually waive the mortgage insurance so the client never pays it.
If it's still 3% down for a conventional or an FHA, why would somebody choose one or the other? Would you get lower rates at the FHA? I mean, I know that the house has to pass certain conditions with FHA and not conventional. Like, what would be the benefit of one over the other necessarily?
So we always do, for those clients, I typically will do a side-by-side comparison. We'll send them numbers with both. We'll send them with FHA and also conventional. A couple of reasons why you would go with FHA. FHA is way more forgiving on credit. Like if you've got a bankruptcy, if you've been in foreclosure, if you're actively in bankruptcy, we can do an FHA deal. I do about 1 or 2 of those every couple of years. And I always tell myself I'll never do it again. But if you guys have somebody who's in bankruptcy that wants to buy a home, give me a call. So the credit profile that FHA accepts is way more liberal than the conventional. Conventional typically will have lower mortgage insurance with good credit. Like that's the caveat. You have to have good credit to get the lower, and then so those are the 2 reasons. And so usually what we do is I don't show people numbers until I've run credit just because I just don't think it's honest. Like if I quote you a rate and then I show you and then you show up and I say, I feel like a car salesman only wanted this price. You know what I mean? Like I'd rather pull the credit, look at all the income, and then I put the 2 together. There are situations where the FHA rate, because they have maybe not the most stellar credit, it's a lower monthly payment and lower closing costs to go that way. There are some fees that are baked into FHA that make them a much more expensive loan, but sometimes people just want a lower monthly payment, and that's how they get there. I probably push conventional in like 90% of cases. The reason I do that is because it's an easier offer to get accepted, especially in Monterey County. Like you say FHA out here and people they think you have some sort of alien. Like, what's wrong with your clients? Why would they use FHA? Like, it's a big deal. So you got to be careful. Just sometimes it's just about how can we actually get their offer accepted and how can we get them into the house versus. So the short answer is FHA looks better if your credit is not as good. Conventional is much easier on condos. And that is that first time buyer. A lot of times when you're doing 3% down and 5% down, they're going into condos. If you're doing a condo with FHA, the whole HOA has to be approved. And that's not true of conventional.
I may have missed it. In your recent explanation about FHA versus conventional, did you mention that FHA also has tolerance for higher debt to income?
They do for sure. Yeah. So FHA will go like 47, 56, meaning you can do more than half of your monthly payments with taxes, insurance, payment. They'll go to a really high debt to income ratio. So sometimes we'll try to qualify people on that if they don't qualify for conventional. To be clear, like we want to make sure that people understand that they're getting a payment that is that big, right? Like if you make $10,000, so you make $120,000 a year, that's $10,000 gross, and we're qualifying you for like a payment that's over 5,000, that's hard to live through, right? Because most people get their taxes withheld. So let's say they're making 10, but they're really only touching 8,000, and then you're giving them a $5,000 mortgage payment. You're signing up for that can be painful, right? So we try to educate them on that as well. We always show them the payments up front before they go into contract. We want them to be looking at their numbers and know exactly what they're writing on. There's nothing worse than having an approval, getting into contract, and then they go, wait a minute, the payments are too high and they want to back out. Makes everybody want to shoot the lender. And I don't look as good with bullet holes. It's true.
The coffee will go right through you.
That's true. That's true. It'd be no problem.
So in other words, like, I'm sorry. In other words, like FHA can basically be more risky because they're allowing a higher debt to income ratio because you want to lower down payment, but you can also, okay.
And that's part of the reason their mortgage insurance never goes away is that mortgage insurance is making sure that their default rate isn't that bad, right? So
that makes sense. They've
factored it in, and so they're willing to be a little bit better with risk. Typically, FHA pricing is a little bit better. Like I'm like 1/8% better or maybe 1/4% better. So if everything else is at 7, maybe you're at like 6.75 on FHA. And they can do almost anything. Like FHA and I do more VA loans than anybody in the county, and the reason for that is they're awesome. Like you can get anybody approved on VA. Like you don't have to have good credit. So
Yeah, sometimes some listing agents don't understand the beauty of a VA loan. So sometimes they need a little education on a VA loan. So have Jeff give them a call if you're writing for a client that has a VA. You know, let them know if they want to hook up with Jeff and learn a little bit about it because they're great.